We're going to get going here. Next time I do these, I'm going to have a countdown and or some sort of background music as everybody comes in, just to make it a little bit more friendly. So hello, everybody, and welcome. Today, we're going to be discussing the markets, the economy, all of those kind of things post-election. So most of you out there are very much like America. You've got, political views that you hold strongly, and recently carried those out via the voting booth. And now we're all taking a look at the results and figuring out what's going to happen next. And so probably half of you are pleased with the outcome and half of you are not, based on the overall look of our economy, et cetera. So as we get going here, just want to let everybody know we're going to have the chat open. So if you have questions and you want to throw those in there, I'll try to address them as they come up. I may have to take some of them then at the end as well, but we'll have a chance to take your questions, because I'm sure some of you have some things specifically you want to learn more about. Good to hear from Mary that it's warm in New Mexico, because here in Iowa it's freezing and rainy and gloomy. So fall has come, and that means golf courses are going to be closing, and we've all got to get back to work and get ready for the holidays. So here we go. All right, so I'm going to have a slide presentation here I'm going to bring up, and I've titled today's conversation "New Boss, Same as the Old Boss." Pretty clear as to why I'm doing that, because we've seen this before. We've seen it before where we've had this president in place. And so as we're coming in, there's been a lot of chatter and noise around a number of different things. So I'm going to focus on primarily 5 issues as I see them that are taking place that we need to discuss. And those 5 areas of impact are the economy, taxes, investments, interest rates, and then what I think might be the most important part is investor behavior. How do we all react as a result of these things? So as the cabinet's being put in place, and as we're seeing a lot of the policy prognostications come out, it's been interesting to me, because I've read contrasting opinions, as many things as I could get my hands on, quite frankly. Attended other webinars and podcasts, trying to learn what is going to happen. And just like in so many things when it comes to the markets, the economy, the future, nobody really knows. However, there are definitely some markers here that I think we can work from, and some indications as to what might be happening and how we might need to adjust or react. So as soon as the election was over, you saw the market really rally. A big part of that, frankly, is just what they call the relief rally. That it's a known. When we came into the election, throughout the year, I was telling everyone not to make changes based on the election, because we just don't know. Well, that's not the case anymore. Now we know who's going to be in place, what the legislative cycle is going to look like, what priorities are going to be put in place. And so when I go through these today, I wanted to discuss also what can get done via executive order quickly, what can get done is going to require congressional support, and what that might mean for some of these prerogatives. So the first thing I want to do is take a look back at Trump's first round as president, some of the things that he did. The Trans-Pacific Partnership, so the trade agreement between Canada and Mexico, was something that he broke up. He did want to address immigration. If you recall, he said he's going to have a wall built between us and Mexico would pay for it. That didn't come to fruition exactly as he planned, but immigration was a priority of his presidency. Energy policy was very much back to fossil fuels and encouraging domestic production. All things domestic are always of interest, it appears, to President Trump, where anything that can be done in America and can be done better in America is something that he's interested in promoting. And then he also spent a lot of energy, no pun intended, on Obamacare, trying to repeal Obamacare. There wasn't a clear path to what would be replacing that, and so it never came to fruition, never made it through the meat grinder that I'll speak of frequently today. When something has to go through Congress and the Senate, regardless of who's in control, there's a lot of giving and taking and a lot of things that have to be done to make that work for folks over time. All right, so I found this slide interesting, because what it talks about is something that I actually learned from the TV show The West Wing. So I don't know if any of you have ever watched The West Wing, but Josh Lyman is the deputy chief of staff in that show, played by Bradley Whitford. And he's just getting off the re-election of his candidate, Jed Bartlett, on the show. And he's finding out that people a week or two after the election are trying to lock up the folks for the Iowa caucuses, the caucus chairs. And he makes some calls and he figures out it's the vice president. So he goes to the vice president and he says, you can't do this yet. We haven't got any of the party in place yet. We just got elected. And the guy's like, I've got to get started because I need to get there running. And so Josh commented that, wow, it's shorter every year. And what he was saying is we basically have 18 months. And in this slide, it's saying basically in the first 2 years. So most presidents get most of their accomplishments done right out of the gate. You can see that from Clinton to Bush to Obama to Trump 1, and then Biden with the Inflation Reduction Act, the CHIPS Act, those kind of things. And I think the primary reason is that they have a bit of a mandate. They've come in with some euphoria. They get their first 100 days to get things rolling. They get their cabinet in place, hopefully. And then they hit the midterms. And most of these presidents all felt the pain of the midterms, where the other party would usually win, sometimes in revolutionary fashion. That definitely happened to Bill Clinton at his midterm election first go around. And so what that portends is that what we're going to see is probably a lot of quick initial action coming out of this president as well, because unlike some of these other predecessors, he doesn't have a second term to work for. He's going to be going for these first 4 years and then he's done. And so my expectation is that he'll get to the midterms and then they'll all begin positioning for maybe a Vance run or something like that. So I tell you that because you're going to see a flurry of activity, and you shouldn't let that alarm you, because this is how it goes. You're going to see a lot of the action go on early on as to getting his agenda in place, moving these things forward as quickly as he can. All right. So the way that we want to look at some of these things in the economy, how they're going to impact us, is once again how that's going to go through the meat grinder. So we need to start with tariffs. You've heard Trump talk about these frequently. He wants to place a surtax basically on goods that are coming into the United States. President Trump has always had a bias that he feels that our trade deficit is basically making our country weaker, and that our economy is flooded with cheap goods and other countries are benefiting from the sales of those, which is true. However, there's a lot of economic back and forth about the real benefit of tariffs. So if we're looking at the economy objectively, in many cases when tariffs are in place where they're taxing goods that are coming in, it does create inflation. It does create prices going higher. I want to thank Will for putting this slide together for me, but it just talks a little bit about a tariff, and it's basically a domestic tax levied on goods as they enter the country, proportionate to the value of the import. He's talked about doing this with countries in the EU. He's talked about doing it with Mexico. He's talked about doing it strongly with China. So the plan here is if you're selling something cheap into the United States, that you pay a surtax on the way in. Many companies then will pass that surtax on to the consumer. They're not necessarily just going to absorb that as part of their profit metric. That then could create prices going up. Prices going up is obviously inflation. So it looks like on its surface that tariffs are inflationary. I found a really good article from Geopolitical Futures, and I just want to read a couple lines from it because it does address this tariff issue and what it might mean. So the central goal of Trump's trade policy is unchanged from his first administration: to reduce the United States' reliance on foreign, particularly Chinese, supply chains and shift manufacturing to the U.S. and friendly countries. Also, like his first term, Trump's preferred instrument is tariffs. So a little bit unlike the meat grinder, he can do this with executive order. So he can assign these tariffs without having congressional approval. So I would expect you're going to see these come out on day one in some way, shape, or form. A lot of people are prognosticating that he may be using this as a negotiating tool, where he can get better deals from other countries. I read a thing this morning about Britain, and that's very likely there because their economy is similar to ours. There's not a huge trade deficit that we're running with them. He admires them for Brexit. And so there is where there might be some room for just to use this as a negotiating tool. With China, I think he wants to go all in to get their attention, that he's serious about this and really wants to penalize their goods coming into the country. I think this is going to have a mixed response. I think you're seeing the market already price some of this in. They're expecting this to happen. The inflation number this morning that came out was a little bit higher than it was last time. So we are seeing a little bit of this already take place, and you're seeing the market price this in. And as in all things with the market, you're always going to see the market anticipate that beforehand and come in before that is, actually taking place. The market's trying to figure out what it's going to mean over the next number of months. And so that's what we're seeing shape here, is that tariffs are expected in some iteration, and how it affects the economy is something that will have to be determined over time. So then we can talk about immigration and employment. So the labor supply is, we're getting a lot of assistance. What this chart shows us on the upper right-hand side, the blue bar is showing us that we are getting a lot of labor support from foreign-born residents inside the United States. Now, it doesn't delineate whether they're legal or illegal. I point this out because the immigration policy is very clear. He's already appointed a border czar. It's very clear what his plans are, is to deport numbers of, people out of the country if they're here illegally. And so what that's going to create is a little bit of angst for some companies as to where they're going to get their workers. So my hope is that taking this through, this is something that he will have to get done through Congress. He'll need some congressional support, whether it's for funding of taking care of these actions, et cetera. And so in all things of his agenda, when Congress is going to get involved, it's not going to be the blank check that I think a lot of people think it's going to be. These folks work for their constituents when they're in Congress and the Senate. And so they have to go back to their constituents and try to get reelected here in 4 years when Trump's going to be gone. They're going to be careful as to how this might impact their companies, their constituents, their tax base, their everything that goes on in their economies and in their states. That then, in my mind, means that they're not just going to say, okay, this is absolutely okay for you to take 100 workers away from a manufacturer in Nevada, Iowa, for instance. So I think a lot of this is going to get tempered a little bit, is my point. And I think we're still going to need, while the labor supply is already, low, it's been low coming out of COVID for a long time. It's gotten a little bit better. We don't have the demographics to support the growth this country is positioning itself for. So we're going to have to find some sort of smart policy that brings people into the country that can do the work. So I think this is going to be an interesting thing to see how it plays out. There's a ton of rhetoric on it right now, but the economic reality of it might shake a few things loose. Okay, the second area then is taxes. And so when Trump's first term, he passed the Tax Cuts and Jobs Act that lowered some of the income brackets. It lowered the corporate tax. It added a qualified business deduction for business owners, and it capped the amount that you could deduct for your state taxes at $10,000. The expectation was, if it was a Harris presidency, that these cuts would expire next year. They're going to expire next year no matter what, but that they would not be extended. And now with the Trump presidency, it's expected that they will be extended. That then likely means that there'll be some horse trading as to how other components of it work. So he wants to lower the corporate tax even further. And many of the states like New York and California want that SALT cap eliminated because their taxes are high in these high taxed constituencies. Once again, congressional approval on this. So it is going to have to go through a back and forth. There will be, I'm expecting a lot of trading on this one because there's so many components to it. In many cases, when they get these types of tax cuts made and changed, they put a time limit on it, just like they did with this one, that we'll agree to it, but it's got to expire at a certain point so we can take another look at it. This also is going to include the estate tax, which is right around 12 to 13 million per person. And it's likely that will stay that high at that level, at least, and then index it for inflation like it's been in the new one. So when taxes are lower, especially the corporate tax, that is good for companies. And I think you're seeing the stock market bid up during this time because they're expecting more corporate cash flow. So remember, companies return profits via their stocks when they have free cash flow, when they're advancing dividends, when they're doing stock buybacks, making those shares more and more valuable. They can do that with a clear path as they understand what tax policy is going to be so they can work around that. And then the other area is just free cash flow. If they have more to spend, they can invest in their companies, they can hire more workers, do all the things that make companies grow over time. So the growth that you're seeing in the markets here early on, the relief rally combined with the expectation that tax policy is going to stay pretty much the same that it was, potentially go lower. He also wants to eliminate taxes on tips, Social Security, and then I already talked about the SALT exemption there a little bit. That then will be part of this overall process as to how that works. It'll be interesting to see. Okay, let's talk a little bit about investments. It's kind of interesting to me because the expectations of what parts of the investment markets are going to do well when a president steps in actually tends to be a little bit different, and I'll demonstrate that here in just a moment. But I think the areas of investments coming into this that I felt that some of the biggest trends are are deglobalization and infrastructure. If you're in the Des Moines area, there's about 14 cranes over at the airport right now as they're rebuilding that terminal. Tons of federal money flowing into infrastructure, bridges, airports, all the things, data centers. You're seeing it everywhere. I think that trend is one of the biggest ones that we've got going in our country, and that it's going to continue. And the deregulation, dropping regulations, is only going to make that a further reality. You're going to see this in the energy markets. You're going to see it in infrastructure. You're already seeing it in the pricing of banks. The expectation is that bank regulation is going to change, which could lead to more bank profitability, but also consolidation. Because that's basically, you remember a time when I went to Smith Barney in 2008, I had been there for a couple months, and all of a sudden Morgan Stanley bought them. Of course, this was during the tsunami of the 08, 09 mess. However, the consolidation in the financial services industry was ripe. And I think you're going to see that start happening again. We were just talking this morning amongst the three of us about how many banks there are in Des Moines, how many banks there are everywhere. So some of that consolidation can be useful for getting better rates, for efficiencies for the banks. There's just a lot of community banks that operate in a number of different areas. And the big ones, I don't think you may see a lot of change there. But you're already seeing some of those bank stocks and financial stocks really go up because the expectation is some of the regulatory reins will be pulled in. The other thing I think that you're going to see in the market is what I'm calling market breadth. If you've sat down with me over the last year, you have heard me talk about how the market is so heavily concentrated in the top 7 stocks, the Magnificent Seven: NVIDIA, Apple, Microsoft, Google. These names have had huge run-ups, and it's all been speculation based on our artificial intelligence and the growth there. They've been able to invest huge amounts of money into artificial intelligence and the growth of that area and the potential revenues that could bring. The other 492 stocks have been essentially ignored in the S&P 500. I think that's where you're going to see your growth, because they're trading at 16 to 17 times earnings, which is basically the price tag on those stocks, versus 30 times earnings plus for the Magnificent Seven. So the old school industrials, some of the healthcare areas, ones that are more cyclical, that do well during the holidays, but not maybe the rest of the year. All of that part of the market has not really participated. It's done fine, but I think that's where you're going to see your opportunity. And we're going to see the market really begin to spread itself out. And that's where we're beginning to try to position our clients for those opportunities while protecting ourselves from the risk of these higher priced companies that have really gotten bid up. Because as soon as there is some sort of disruption, it's the higher priced ones that tend to lead us down most quickly. I am going to do a poll. So if you're all nearby your computer and can enter this, we will have our little poll here. Hang on one second. Oops. All right. My question to all of you is, did traditional energy stocks, so think Exxon, Chevron, perform better under President Trump, or do you think they did better under President Biden for their administration? So 2017 to 2021, and then 2021 till now. Getting some answers in. Give everybody just a few seconds here. All right, a couple more seconds and I'll end it up here. Traditional energy stocks, they perform better under President Trump or President Biden? All right, I'm going to wrap her up. Okay, so we have 60% saying President Biden. We have 40% saying President Trump. In that. All right, so if you can see this chart, basically this is the energy index, which is the orange bar, and the global clean energy index, which is the top blue bar, and then the purple is the S&P 500 for that period of time. So even up to the point during COVID, clean energy did far better under President Trump than traditional energy stocks. And if we look then at President Biden, we've seen the opposite. Traditional energy stocks have done far better than clean energy, which is the orange bar in this case. So isn't that strange? Because their policies were completely the opposite. They were promoting more of the old school energy in the Trump administration, and promoting more clean energy in the Biden administration. However, their stocks did completely the opposite. I show you this as really a cautionary tale to tell you that the expectation that their policies are going to lead to certain outcomes in the stock market aren't always the case. So when we're making investment decisions, we can't say, wow, crypto is at 82,000, excuse me. Bitcoin is going through the roof. Trump's said that he's going to be friendly to crypto regulation. And so I should put all of my money in crypto because that's the way it's going to go. I use that as a one-off example, but it's been very clear that that's not always the case. So while I'd say that financials could do well in this administration, doesn't necessarily mean that they will. And that's why we want to, again, diversify, be smart about our allocations when we're looking at investments, because we can have these kind of surprises where you would think the general knowledge of what their policies are going to do doesn't always translate into the economy. And the economy and the market is going to do whatever the hell it wants. It is not going to care about a policy unless that policy is for some reason shutting down an industry or making a big change. But over time, it's going to be how companies and the companies inside of those sectors perform. That's why I like the market breadth story, because I think you're going to get an opportunity to see a lot of different areas potentially do well over time, and trying to pick just a specific area of winners, like saying I'm going all in on big tech. Same thing. If I showed you this chart for big tech, you're going to see a similar response where big tech's done great under Biden, didn't do so well under Trump. So go figure. Okay. Next thing, and I'm not going to spend a lot of time on this, is just interest rates. A lot of our conversations prior to the election were about interest rates because we were concerned about what the Fed was going to do. Are they going to lower rates? Are they going to raise rates? Are we going to have inflation? Are we not? They've begun their cycle now of beginning to bring those rates down. We saw that even here recently with another 25 basis point lower. They are throwing fuel on the fire. We have profit margins in the economy just growing like crazy, or at least, not going down. And at the same time, the Fed is lowering rates. Unemployment is low. It's baffling because this is not generally when they do this. They will generally do this when we have trouble, when we've hit the skids and we need the economy to be ignited. It's already running pretty hot. So if you add the fuel now of tariffs to all of this, making goods a little bit more scarce, driving prices up no matter what it may be, that is, in my mind, very inflationary. And when inflation goes up, the Fed has to raise rates to counter that. It's going to be an interesting dynamic. President Trump has been a vocal critic of Chair Powell. Chairman Powell came out this week and said, would you resign if Trump asked you to? And he said no. So we've already got a little bit of a Twitter war, I'm suspecting, is going to go on between these two once he gets in, because you can't fire him. He can appoint his own chief here in about 18 months, but he can't fire Chairman Powell under the current rules. I think what this is going to mean is that the policies that we've seen from Chair Powell are, I want to keep our data points in line, and I'm going to keep doing that regardless of politics, very much the same, because when he was raising rates like crazy, he was getting a ton of political heat. When he began to lower them, he was getting political heat. You can very much expect him to continue to take that kind of heat throughout the remainder of his term. Hopefully he'll hold to his convictions and do what's right here. But how this is going to play out in the bond market has got me a little bit concerned. I think the bond market's going to tell us a story about what's going on in the overall economy and all those kind of things before the stock market necessarily will. So I'm excited. I'm not excited. I'm interested to see how this plays out. And this part of the market is going to be one that's continuing to tell us a story, I think. And while we want to be in bonds, I think we're going to stay in those shorter term maturities till we see how this shakes out. But what we are beginning to see is that longer term rates have begun to come up a little bit. And so that's not something that we've seen here in a while. And as always, we want to make sure we're using bonds as a good hedge in our portfolios, but we also don't want to get creamed if rates really start to go up. Last of the 5 topics then is investor behavior. And so what can easily happen when we have a new president, new policy metrics coming out, all the things that create all of this big change can cause us to make bad decisions, because we have either a recency bias that, wow, this happened last time, it's going to happen this way again. Or we look back at President Trump's first terms and thinks this is going to happen exactly the same way in his second term. We think that tariffs are highly inflationary, so I should just go to cash. All those kind of things can cause us a lot of damage. Everything that he wants, he's not going to get. It's just the nature of politics. It's just the nature of the way policy works in this country. And we've built the system this way for a reason, so that there are checks and balances along the way. It can seem like in this environment, and I get it if you feel this way, that there's fewer checks and balances than there should be. We'll see. We'll see how this plays out. Once again, we have a different dynamic here where this is a short period of time. These first 18 months are going to tell a big story, and we can adjust accordingly. We're also at market highs. That always causes people to be concerned. I was just at our conference with Sanctuary, and Marianne Bartels had a number of different charts. She's a real technician. She uses charts and momentum, market history, how markets are breaking in different directions, and showed a number of compelling charts to show that the market could definitely continue to march up from here. And in many cases, when you have market highs and the Fed is lowering interest rates, once again, fuel on the fire. You have a real good chance for markets to continue to grow. So as always, we're going to be cautious. We're going to make sure that we've diversified and kept people in the safest places that we can that can still get us the rate of return to meet our plans. That's going to require then creativity, the third thing there. So finding new ways to hedge, finding new ways to diversify, maybe putting some insurance in the portfolio via options or some other things that we can do. But we're not going to sit on our hands. We're not going to say, let's just buy the market and hold because it's going to go up forever. It's not. There will be something that comes along that changes things. And so the other thing, though, is that I really encourage everyone to avoid the noise. And by that, I mean the short-term noise, the noise that you get from the news. CNBC exists to sell advertising. I watch and listen to CNBC a lot because they bring guests on that I find very informative, and I want to hear their opinions and bring those opinions to you. But if you allow the daily swings in the market or this data point or an upcoming debt ceiling fight, something that's going to be pushing itself through Congress, it's never been proven that any of that works over time. So just want everybody to recognize these biases perhaps when they're arising. And when you feel that fear and you feel this, boy, I should really be making big changes. In many cases, that's not the case. Things will level themselves out. We definitely saw that after COVID, which was a huge shock, a huge scary time in the market, but we've recovered from that and moved on from it. And so whatever's coming next, whatever is out there around the corners that we can't necessarily see, we need to be well prepared for by knowing that our portfolios are ready for a range of outcomes. I want to show you this slide because it just shows, to demonstrate my point. The lower end of the chart shows if you just invested with Republicans or if you just invested with Democrats over the last 70 years, or if you put 1,000 to work and let it grow. This shows then over time, the staying invested, staying the course has definitely been your best course. I know all of you hear me say this, and it probably gets very fatiguing for you, and I'm sorry, but it's what works. And it's my job to make sure I'm giving you what I feel the best advice I can. And so this is just, as a data point, proves that. So one thing that I do, I'm going to stop the presentation here one sec. Bear with me. One thing that I'm concerned about, and it's not something that we're hearing a little bit about it now, but we haven't heard about it over the last number of years, definitely not in the political cycle. Our federal debt is growing to levels that are not sustainable. And something is going to have to be done. There is zero political capital on this, or political. I was looking for it in this last election for somebody to bring it up as to what we're going to do about our spending and our deficits. Trump did a lot of spending in his first term. Biden did a lot of spending. Bill Clinton was the last president that had a surplus when it came to spending. So it's been contagious across the presidential divide. Ray Dalio, John Malden, people that I really respect and read are bringing this more and more to people's attention because the math isn't going to work forever. Something is going to have to be done. How this begins to shake things out, or how this becomes either a crisis or how it becomes much more front and center than it has been, is going to be interesting. For now, it's sustainable. For now, it's worked. We're not having to pay huge amounts of interest on our debt. But we just saw it even when inflation going up. You know, we have huge entitlement costs already through Medicare and Social Security and defense. We have these huge areas of our economy that are what I'll call almost fixed costs. There's set numbers. The other third or so is somewhat discretionary. We could cut almost all that discretionary spending and still not have enough to pay down our debt meaningfully. So it's going to require a change in either taxes, spending, all of it combined is going to have to be put on the table at some point. This is an area that I'm challenging myself to learn more about and how I can protect my clients from whatever this tsunami whenever it may hit and what that might look like. But I'm not saying it as we need to get out of the markets, we need to make big changes. I'm putting on your radar that it's something that's going to have to be dealt with. It can't just be ignored forever. And if you want to know what it's like when it's ignored forever, take a look at what happened in Japan for the last 30 years, because they had a demographic policy, not a demographic shift where everybody got a lot older, was using all the entitlements. You had a lot fewer productive workers, no immigration, and they went into a massive recession where all of their prices, markets, housing, everything went down. So I'm hoping that we can get in front of this as a nation. I'm hoping that we have smart people that can make policy changes as needed, and we'll address this issue. But in the meantime, it's something that I will continue to bring to your attention because I think it's important, and I don't feel it's getting the attention it deserves. So we'll do what we can as investors and as community members to do something about that. So, okay, those are my comments for today. Thank you all for joining. I can tell when I've hit a nerve based on how many folks I get interested in our little presentations here. And this one got a lot of interest, as you can probably imagine. Many folks are concerned, and many folks are interested in what this all means and where do we go from here. Both where can we find the opportunities, and both where can we protect ourselves. And that at Prairie Fire is our job to make sure we're helping you manage that as best as possible. If you don't, Lori was asking for a hug. You bet you can have a hug. We're at 2580 Fleur. You know where we're at. Come by anytime. Make sure Lisa's here. She's a better hugger than me. So yes, it's all going to work out. I don't know if it's going to work out the way that we all want it to, but I think both the very, very dour folks and the very, very ecstatic folks are going to find some surprises to both directions. Most of these things tend to have a way of filtering themselves through. And especially when we're getting congressional action, there's just a lot of grinding back and forth before we actually get a result there. So no president gets everything he wants or she wants. And so we'll see what comes of this. I will be paying close attention, as you can imagine. More than anything, thank you all for being here. Thank you for being part of Prairie Fire. Best wishes for a great holiday season, everyone, and get to be with your family and hopefully get to do a little fun travel, things like that. Always welcome any questions, concerns, comments. Just shoot me a message. You all know where to find us. So thank you again, and have a great Wednesday.